Welcome to another episode. I'm your host, Ryan Richards, a residential loan officer and real estate investor based in Massachusetts. And today I'm hosting a solo episode, deep diving into the realm of financing, different types of financing that you can utilize. What are the advantages? What are the disadvantages? And when should you consider using one versus the other? So, hope you find this episode valuable. Thanks for watching. So today I wanted to dive into different types of financing and when it's important to consider one type versus another and some of the drawbacks, right? Every type of financing has different flexibilities that come with different drawbacks. So first, it's really important to understand the financing debt relationship. So as a lender, if I'm going to lend you money, my terms are all reflective around the equity position of the deal and the likelihood that I would expect you to pay that debt back timely. So it's not just about the money I'm going to make on it. It's about when I'm going to get my money back and how quickly are you going to repay that debt. So with that, the more flexible that lending gets in general, the more the terms compensate for that. So typically the higher the interest, potentially the shorter the terms, and potentially some other prepayment penalties or other types of measures around more flexible financing. So what are the main types of financing to consider? Well, in terms of real estate financing, which will be the whole focus of this podcast, there's really 3 or 4 different types of financing. You have your conforming financing, which is what most people think of and utilize to buy like a single family property. Ultimately, this is 30-year, for the most part, fixed debt, potentially with fixed mortgage rates and relatively low interest and upfront costs. Now, other types of debt could be non-conforming financing, which is very similar to conforming. Obviously, they share a very similar title, but non-conforming allows you to stretch the criteria and qualification standards of traditional financing. So it creates more flexibility. This could be someone who would like to qualify off of their bank statement deposits as opposed to tax returns. This could be debt service coverage loans for in real estate investors. This could be P&L, profit and loss statement based loans, or 1099 profit and loss statement loans. So as well as asset-based lending, we can lend based on assets you have in your account as opposed to actually looking at job or employment income. So they stretch the flexibilities a little bit of traditional financing and tend to have slightly higher interest rates than traditional financing, but slightly lower costs than the next category of financing, which is private and hard money. Ultimately, hard money is a form of private financing. It's from a private institution or a group of investors, could be from a fund that ultimately is lent against hard assets. So hard assets being typically real estate. So they're lending you money based on the value and the perceived value of a hard asset of real estate. So typically these are shorter term financing vehicles. Typically they're higher interest. So hard money debt might be anywhere from 10 to 13%. And they might have a couple upfront charges. So it might be more expensive upfront. But typically hard money notes are only a year or 2 years. So very much geared towards a specific type of investment. But they're very flexible. They don't even tend to look at your credit. They don't usually look at your income. They're purely based on the opportunity in terms of the deal you have in front of them. What is the value of the project you're looking to take on and what is their risk exposure based on that deal. And then the last type that still falls in the same bucket is what we call private money. So what most people are familiar with private money is private individuals lending money. So that's your uncle who might be semi-retired and has some extra money laying around. You want to invest in a real estate project. You don't have the cash. You go to them and you work out some arrangement to say, hey, I'd like to borrow X amount, say $300,000 to buy this property. That's private lending. It's very much relationship-based lending. Doesn't have to be an institution, could just be a private individual. So that tends to have a little bit less aggressive terms than hard money because there's that trust factor. You have to build that sense of trust if someone's going to lend you several $100,000 without underwriting your income, your credit, your employment, and all the standard criteria we would look at otherwise. So it tends to be really flexible. And the last type of financing is commercial financing. So commercial financing in terms of real estate typically refers to commercial assets. So commercial buildings. That could be the strip mall down the street. That could be the mixed-use plaza that has a Subway and maybe it has a hairdresser and a muffin shop. That type of financing to buy that building would fall under commercial financing, but it also includes multifamily of 5+ units. So 5+ units would be looked at from a commercial lending perspective. And commercial lending, typically it's done by banks or credit unions. Commercial lending is for larger assets, and it's really underwritten off a different approach. It takes some of the components from each, and ultimately commercial lending is based off of the performance of the asset. So it's largely driven upon income. So if I was looking at buying a 5-unit building, a commercial lender is going to look at my qualification based on what my down payment is going to be, and really what that creates for a monthly payment compared to what I'm expected to get in terms of rent. But they're also going to include expense factors. So they want to understand that the property you're buying is going to perform well enough for you to repay back that mortgage, regardless of really what's going on in your personal financial world. They're lending based on the performance of the asset. So they'll look at your expected rental income. They'll take out your expected mortgage payment, minus some expenses, some reserves for repairs, maintenance down the line, even some vacancy factors for multifamily. Tenants, they can leave, they might not pay rent. They want to account for that lost rent. So based on the performance of the asset, and they have typical, minimum ratios that they look at to determine whether or not that would be a loan that they would do under the assumption of a certain down payment. So a little bit different than some of the other types of financing, but it's really, a blend of all of them. So now the question is, when do you use what type of financing and who do they make most sense for? So to start at the beginning, conventional conforming financing, that's your typical residential loan. So if you're looking to buy a single family, if you're looking to buy a condo, you're going to live in it, maybe you're going to rent it out, you're buying a 1 to 4 unit multifamily, that's where conventional lending falls as typically the vehicle of choice because it tends to be 30-year fixed debt, tends to have lower interest rates, and there's a lot more lenders who offer that type of financing, so it's very competitive. But the one downside to conventional lending is conventional lending looks at your qualification based off of your employment income compared to what you have outstanding in debts, for the most part, right? If you're looking at a multifamily, we will still give you credit for some of the rental income, so we'll help increase what you qualify for by giving you credit for that rental income. But for the most part, it looks at how much you make each month from your job, plus maybe some rental income, compared to how much you have outstanding in monthly payment obligations. So in general, conventional lending will allow you to access 50% of your gross monthly income to qualify. So let's say you were looking at a property and you make $10,000 a month. You want to know how much can you qualify for? Well, the only way to know truly how much you qualify for is to apply for a loan formally and get a formal approval from an underwriter. But to give you an idea, in general, let's say you make $10,000 a month. Well, we can use 50% of your gross monthly income for you to qualify. So 50% would be $5,000 a month. So $5,000 a month is the most amount of payment obligations you can have on a monthly basis. So let's say you have a car payment that's $500 a month. Let's say you have student loans that total $500 a month. Let's say you have another, credit cards that total another $500 a month. So out of the $5,000, $1,500 is already taken up going towards your personal consumer debt. So that leaves us with $3,500 left in available payments to use. So essentially, we're going to figure out what mortgage payment will be within $3,500 a month and how much that equates to in terms of a mortgage. So rough math, $3,500 a month is probably close to $475,000, maybe $500,000 for a mortgage. Ballpark, including taxes, insurance, mortgage insurance, and of course, terms can differ depending on your scenario, but about $500,000. So you make $10,000 a month, you have $1,500 in debt, you can have a mortgage payment of about $3,500 a month. And that's typically how conventional lending looks at things. So it's very much dependent on your employment income, which can be difficult to change for a lot of people. And conventional lending comes with a very strict set of guidelines. Conventional lending, really conforming lending, means that standard set of criteria meets the national standards for ultimately residential mortgage lending, if you will. So there's a very detailed list of criteria. It's very much black, white, some gray, but mostly black and white. And they want you to pretty much fit within the box. You'll hear people talk about conventional conforming lending is fitting something into a box. But what if you have a round peg? How are you going to put it into a square hole? You can't. Well, maybe you can. I'm pretty good. But maybe for the most part, you can't. So what we look at is what we call non-conforming lending. It's known as non-QM in the investment and mortgage world. Ultimately, non-QM lending takes a lot of the principles of conforming lending we just talked about, but provides a lot more flexibility because non-conforming lending is ultimately done in large part by private institutions. So companies like Northpoint, my company, will have resources to deliver these products to. We will have investor partners that we can deliver these types of loans to because we have relationships with investor partners that we can provide these mortgages for. So the good part about a non-conforming mortgage, non-QM, is they have a lot of those flexibilities. So this is for that person who wants to buy an investment property but might not have any income. We could look at a debt service coverage loan. That type of product just allows you to qualify solely based on the rental income that the property generates compared to your mortgage payment. Are you going to make enough rent to cover your mortgage? Is essentially how the program looks at it. So much more flexible than looking at strictly your monthly job income compared to your debt to income. Debt service coverage in the non-QM space, they don't even care if you have a job. They care about your credit. That's important. But income qualification is purely based on the property. So it can provide some of those flexibilities. Typically, it comes at a slight premium in terms of interest rate and tends to have larger down payment requirements. There's no money down payment assistance programs in non-QM. They're already flexing on a couple other qualification fronts. They're not going to let you put no money down. They want some skin in the game. And the rates tend to be a little bit higher. Sometimes the upfront cost is a little bit higher, but not always. But it provides that flexibility. So one common example I'm seeing, I have a couple people using these types of programs right now, profit and loss statement loan. Let's say you're self-employed. You're looking to buy a house. Self-employed in the conventional space, we would look at your past 2 years of tax return income, and we would average those 2 years together based on 2 years of net income averaged together. So let's say year one, you made $50,000. Year two, you made $100,000. So $150,000 over 2 years averages out to $75,000 a year in income that we're going to use. But let's say year to date, the example right now, this episode will probably post sometime in October of 2024. Let's say year to date so far, you've grossed or netted rather so far this year, $250,000 so far this year. Your business is accelerating. You're doing really well. You want to buy a house, but you haven't filed your tax return yet because it's not due. We can look at that as a profit and loss statement loan. Ultimately, we have your CPA prepare a profit and loss for you based on your actual numbers, and we'll be able to lend based on that profit and loss. So rather than looking at a conventional loan and being stuck with only using $75,000 a year in income under this case, we'll use the current profit and loss statement loan over the last 12, 18, or 24 months. So in this case, if you made $250,000 net over the past 12 months because your business has been growing, we'll use $250,000 in income. So we'll use $20,000 a month versus only being able to use what you showed on your previous year's tax returns, $75,000. So you can qualify for a lot more and have a lot more flexibilities on things. But again, typically those require 10% down minimums, even on a primary residence purchase, and they tend to come with a rate that's anywhere from 0.5% to 1% or more higher than your traditional conventional conforming lending. So they provide those flexibilities. Another common example is bank statement loans. We can underwrite and approve you based on your bank deposits in your bank account over the past 12 or 24 months. Another great option for self-employed. We'll be able to underwrite based on your bank deposits, not the numbers on your tax return. So important to keep in mind, those flexibilities are there in that non-QM space. And it's really important that if you're running into challenges finding lending or getting lending to work for you, make sure you talk with a lender who has these programs. Not every lender has all of these products. So it's really important you find someone who not only has the products, but has experience in using them. Because you might miss out on the opportunity to buy a house and spend thousands, tens of thousands of dollars more in rent just because you didn't have the right guidance or the right person to show you these types of options. So important to think about. Another type of lending that's similar to non-QM, but completely different, which we won't go a whole bunch into, but hard money, private money. Those types of options are really best for investments. So investment properties, you're looking to buy multifamily, maybe even a single family investment property, or you're looking to flip properties. Multifamily, hard money is short-term lending. Like I mentioned, short-term, high interest, and typically high cost because it's a very large exposure. They're giving you money with typically low down payment requirements without looking at your credit or your income, just based on the fact that they believe the property you're buying is going to be worth more than what you paid for it. So naturally, those come with more risk for the lender. And ultimately, when lenders take more risks, we compensate for those risks with higher terms, higher rates, higher upfront cost. So that's really a great vehicle for if you're looking at short-term financing, looking to flip properties, you could consider using hard money. You could also look at using conventional or non-conforming lending, but those types of lending have set criteria on how quickly you can sell the property after purchase, and more importantly, what you can do to the property. And you can't go take out a regular mortgage from a bank with no money down and then demolish your house down to the foundation and say, I'm rebuilding it. Well, if the bank comes, we're going to be like, what happened to the house? Like, that's our collateral. You can't just knock it down. We gave you this loan under the assumption that house is going to continue to be there for 30 years or more, and it's gone. So the hard money gives you the flexibility of being able to do things like that. And you can tell hard money lenders the scope of your project, and they'll be able to come in and say, well, based on what you bought it for, your plan, how much you're going to spend, what we think it's worth, we'll do the deal. And they give you the numbers and can close quickly, but it's very expensive. Private money, of course, is really relationship lending. So that's good for, again, could be used for short-term flip, short-term renovation project, but you have to have those people that know and trust you to be able to lend you money without, in a lot of cases, looking into your credit, your income, and all the details of your financial profile. So it's a trust-based lending that you need resources to find. One other type of financing is commercial lending, like we just mentioned. Commercial lending, something I've used myself quite a bit. Commercial lending falls in the 5+ unit multifamily category as far as I know it. Obviously, if you're buying an industrial building, you're buying a warehouse, that's all commercial financing. That's the type of asset, commercial property, mixed use, retail centers, malls, strip malls. But in my sense, it's multifamily is how I know commercial financing. And commercial financing is ultimately, again, it's underwritten based on the income from the property. But commercial lending is similar to private lending because it's given by banks, credit unions. They tend to have their own resources for the most part, but they can get flexible with you because they make their own set of rules. Aside from government regulations, they can flex with you based on a combination of all the types of financing, really. Because commercial properties are bigger and usually bigger in price point, bigger in complexity, and usually they come with larger down payments. So commercial looks at your ability to control the asset based on trust. What's your track record? Track record is huge in commercial lending. There's very rarely first-time commercial loans for someone trying to buy a 40-unit building. That's not going to happen. The bank wants to know what your ability is going to be to operate this property and ultimately get it to perform at the income you're saying it can, which is the whole basis for the loan they're giving you. So track record's really important in commercial lending. Relationships are really important in lending. Different banks have different appetites for different types of projects. So it's really important to start to network in that space if that's some type of financing you'll want to go for, because you want to make sure you find the right lender who has the right appetite for the deal you're throwing them or proposing to them. So really important on that standpoint is the track record, which, if you're thinking of taking down a 5, 10, 12 unit building, one way you could get into that and obtain commercial financing is by partnering with a seasoned investor. You'll both guarantee the note. So you're saying you're personally guaranteeing that mortgage will perform, and both of you will come on together and maybe you arrange a deal with this other person to come in on the deal, and they guarantee their track record, their credit behind the performance of the property so that you can leverage yourself into a bigger asset by just partnering with the right person. And then after one or two of those, you can then go to a bank and say, look, I've done a few of these deals with my partner. I'm doing this one on my own. I'd like to go for a loan. They can see your track record, even though it was with someone else. You have those deals under your belt. When commercial financing tends to be 20, 25, 30, 40, 50% down, depending on the type of asset you're looking to purchase and the performance of the deal. What's really cool in commercial financing is the ability to obtain renovation funds at purchase. There are some renovation products across all these types of financing, but the ability to get renovation funds available on large multifamily property on an extended loan. So that tends to be unusual for some of these other types of financing for the most part. But you can take, for example, a 6-unit building, say you buy it for $600,000. You can put together a construction budget and go to the bank and say, look, I need to get $150,000 in order to renovate this building, raise rents, and bring up the performance to where I need it to be to hit my pro forma numbers, which are your expected rent that you'll get when the property is complete and stabilized. We need $150,000 based on this work. You put together a scope of renovation, a renovation budget, give it to the bank, say, this is what I'd like to do. Here's what I think it's worth when it's done. They'll actually do an appraisal at purchase based on what we call after repair value. So what is the property going to be worth once you do all of these renovations and get the rent you think you will? So they're giving you credit for it before it's even done. And a lot of times what this does is it allows you to build in equity by doing renovation projects that are ultimately funded by the bank. So upon closing, you'll get access to your $150,000 on essentially a construction line of credit. So they'll give you the ability to draw from the line to pay your contractors, or they'll have you disperse directly to your contractors once certain work phases are complete. So allows you to get into a deal with funds available to do the renovations you need to do. And ultimately, a lot of times that construction line will convert to a fixed second mortgage after closing. So it's all in one financing versus hard money. You have to buy it with hard money, renovate it, and then find a new type of financing, get out of hard money, refinance into a longer term debt vehicle because it's too expensive and they're only short-term loans. So gives you the best of both worlds, but you need that track record, you need that experience, and you have to have a good balance sheet. Commercial lending is very much balance sheet based lending. When you fill out a commercial loan application, they basically want you to put down every single dollar you have everywhere. They want to know how much money you have in your 401k, what do you have in investments, do you own, you have stocks, bonds, mutual funds, IRA, how much you have in cash, how much money did you make? Let's see your tax returns for the last 3 years. What's your income year to date? What's your net worth? You do a net worth calculation. Do you own anything on your car? They want to know what's your financial ability. If they're going to lend on a 20-unit building that costs, say, $6 million, and the entire premise of that loan getting paid back is the property's performance, that means it's on you. What's your ability to manage the deal? Can you go in and raise rents, do the renovations as you proposed in the timeline you proposed? Because at some point, the bank's going to want to know you executed your plan. So typically in commercial lending, they have yearly what they call covenant tests. So did you actually do what you said you were going to do? And is the property performing the way you said it was going to? So really important. They look at you as an overall person, your balance sheet, your net worth, your track record to ultimately determine if they will lend to you at higher loan to values with less money down. So those can be great opportunities for bringing in partners who have the resources that you might not, or the balance sheet that you might not, to get the financing. So hopefully you found this episode helpful. Just a quick overview on a couple different types of financing. Obviously, there are so many other options to consider, but my area of expertise, residential lending here in New England, down the East Coast. If you have questions about financing, residential specific, non-QM, or just you want to pick my brain about some financing terms or debt structures, just give me a call and be happy to guide you through it.